All right, welcome back, future CMAs. If you're gearing up for your exams, you are in the exact right place today. We're zeroing in entirely on high-yield, highly testable concepts. Specifically, we're going to take a really close look at a crucial part of the accounting cycle, grouping schedules, and the absolutely critical role you, as an auditor, will play in verifying them. We're cutting out all the fluff today, just focusing purely on what you need to understand, memorize, and actually apply on test day. So, here's our game plan for this explainer. First, defining grouping schedules. Second, checking out a balance sheet schedule example. Third, looking at the risks in automated accounting. Fourth, diving into the auditor's crucial role. And finally, wrapping up with our final exam takeaways. Let's get right into it.
Part 1. Defining grouping schedules.
Okay, I want to pose this question directly to you because this is the exact mechanical problem you're going to face in the real world. Think about a massive modern corporation, right? Their trial balance isn't just a few neat lines. It is a sprawling, gigantic list of thousands of debit and credit balances pulled from every single general ledger account across the entire organization. Now, it gives you a bird's eye view, sure, but it's definitely not a finalized financial statement. So, how does that overwhelming mountain of raw data instantly transform into a clean, beautifully categorized balance sheet that you can actually present to stakeholders?
Well, the answer to that mechanical headache is the grouping schedule. You need to think of this concept as the vital bridge between that raw, messy trial balance and the polished balance sheet. Basically, before aggregated financial numbers are carried forward, related ledger account heads are clustered together. In a mechanized system, every single account gets a specific code. The grouping schedule uses those codes to compile thousands of individual accounts into distinct primary, secondary, and even tertiary groups, all based on the company's reporting policies. It's basically the architectural blueprint that tells the accounting software exactly where every single dollar belongs on the final statements.
Moving on to Part 2. Balance sheet schedule example.
Now, what's really interesting about this is how perfectly categorized these long-term assets are into primary and secondary buckets. Take a look. Under the massive umbrella of the General Ledger Account Code for non-current assets, the grouping schedule creates primary groups. You've got property, plant, and equipment, which then breaks down further into secondary groups like land, building, and plant and machinery. Then you have another primary group for intangible assets, which houses things like intellectual property rights and ICT software. And you've got investments, capturing shares and government bonds. So the software literally just looks at the schedule, grabs every ledger account tagged as machinery, for instance, and rolls it right up into the PP&E line item on the balance sheet.
Let's keep building on this example and look at current assets. And hey, I highly recommend you commit this specific breakdown to memory for your exam. So the primary group, receivables, categorizes down into secondary groups like government entities or MSMEs. Inventory rolls up raw materials, finished goods, and work in progress. And cash and cash equivalents pulls in short-term deposits and actual cash balances. By strictly organizing these elements, the grouping schedule guarantees that when a user looks at the inventory line on the balance sheet, they're seeing a perfectly aggregated, regulation-compliant number.
Part 3. Risks in automated accounting.
But what happens when this perfectly logical, automated system gets manipulated? This sets up a classic exam contrast question: expectation versus reality. Now, the expectation is that because we're using a mechanized accounting system with pre-tested, highly reliable software, the accounts are finalized automatically and perfectly. And it's true. This automated process definitely minimizes the infiltration of everyday human bias and basic clerical errors. But the reality, the chances of unintentional errors and, more importantly, organized frauds cannot be ruled out completely. No way. Because if management decides to inappropriately compile the account heads within the grouping schedule, they can completely misguide the users interpreting those line items. They could, say, bury short-term liabilities in long-term groups just to artificially inflate liquidity ratios. If the underlying grouping is rigged, any attempt at relational analysis by an investor is totally jeopardized.
Which brings us to Part 4, the auditor's crucial role.
Because the methodology adopted in designing the grouping schedule is such a massive potential cause of concern, we desperately need a safeguard. So the absolute crucial point here, and you need to memorize this, are the mandatory checks an auditor has to perform. First up, you have to ensure that the composition of the schedules for various line items strictly adheres to the prescription of the relevant regulations. Basically, it must match legal reporting frameworks. Second, you must confirm that the composition was decided only by the person or persons explicitly authorized by the organization to do so. You're checking for regulatory compliance and you're checking internal authority. Moving on to the final 2 mandatory checks. Step 3, you've got to verify that appropriate customization of the accounting software has been done to meet the organization's specific accounting and reporting requirements. It can't just be out-of-the-box software if the business has entirely unique regulatory needs. And step 4, this is a huge one, ensure the composition of the grouping schedule has not been altered without appropriate authorization triggered by a legal or regulatory authority. These final 2 steps, they are designed specifically to stop management from quietly tweaking the hierarchy behind the scenes to hide those relational discrepancies we talked about. And this brilliantly illustrates exactly why this level of deep scrutiny matters so much in the real world. By really tearing apart the grouping schedule, the auditor confirms that individual line items are appropriately computed and compliant. But it goes beyond that. It empowers the auditor. Once you know for sure that the grouping is accurate, you can confidently administer suitable analytical audit procedures, like relational analyses of financial variables and stage-wise operating results across past periods. That is how you dig beneath the surface. That's exactly how you identify complex, deeply buried errors or systematically plan frauds.
Finally, Part 5, Final Exam Takeaways.
Let's bring this whole shebang together and rapidly synthesize the testable material. Grab your mental highlighters. Number 1, grouping schedules are the hierarchical map translating a raw trial balance into a polished balance sheet using primary and secondary groups. Number 2, while mechanized systems absolutely reduce basic human bias, they still leave room for organized fraud if management manipulates the grouping heads. Number 3, as an auditor, you must verify adherence to regulations, confirm authorized personnel made the groupings, and check software customization. And lastly, number 4, the ultimate goal of scrutinizing these schedules is to guarantee that users, and you, the auditor, can perform accurate, reliable relational analysis of the financial variables to spot complex fraud. I want to leave you with this provocative thought as you dive back into your studying. When you're sitting there in the auditor's chair staring at perfectly balanced, automatically generated financial statements, how are you going to identify a planned fraud hiding behind an inappropriately compiled grouping schedule? Just remember, the numbers only tell the truth if the underlying map is honest.
We're going to equip you with the exact framework you need to completely crush the technology and audit trail portions of your upcoming exam. We're basically transforming you into digital detectives. The financial landscape has shifted, right? The days of just manually checking paper ledgers are way behind us. To succeed as an auditor today and to ace this exam, you really need to understand how technology applies to auditing. So let's jump right in.
Okay, here's a quick look at our roadmap. We'll be hitting 1, the automated audit environment, 2, IT components and tools, 3, computers and auditing tasks, 4, evaluating automated controls, 5, IT audit testing methods, and finally, 6, mastering the audit trail.
All right, Section 1, the automated audit environment. Let's define the digital terrain you'll be operating in. So, think about it. Businesses are shifting practically their entire operations over to information systems. Because of this, traditional manual auditing techniques, they just don't cut it anymore. When a company's processes, operations, and big decisions are carried out using IT systems, that environment is officially automated. And this literally revolutionizes everything, from administrative controls and information flow right down to the preparation of annual accounts.
And honestly, there's a reason the whole business world is moving in this direction. There are 6 specific advantages to automation that you absolutely need to lock into your memory for test day. First, it enables super accurate data processing, making your computations way more reliable. Second, it processes massive volumes of transactions easily, because, machines don't get tired. Third, it makes business processes much faster. Fourth, it seriously improves control efficacy and security. Fifth, it minimizes those pesky human errors. And finally, it offers better integration among all the different business processes.
Section 2, IT components and tools. Let's break down the actual digital infrastructure. Building an automated environment is kind of like putting together a giant puzzle. You've got databases, like Oracle 19c or MS SQL Server. Then your operating systems, think Windows, Unix, or Linux. Next is hardware and storage, so servers, disks, tapes, and network storage. Then you've got network devices like switches, routers, and firewalls connecting it all. But don't forget the physical landscape. We're talking data centers, biometric access at the doors, CCTVs, and even the HVAC systems keeping the servers cool. And topping the whole shebang off is the application software. which ranges from packaged software like QuickBooks to massive enterprise ERPs like SAP and Oracle.
Section 3. Computers in auditing tasks. So how do we, as auditors, actually use computers in our day-to-day? Well, they accelerate our tasks immensely. We use them for everything from audit planning and scheduling to checking the validity, consistency, and reasonableness of entries. They can retrieve key files for standard comparisons in an instant. Plus, computers execute arithmetical computations and do heavy analytical reviews, like ratio and trend analysis, way faster than we ever could. They even help select representatives for vouching based on predetermined criteria and help us prepare flowcharts and document our working papers. Basically, you delegate the heavy lifting to the computer so you can focus on the critical thinking.
But that brings up a really crucial question. If the computer system is automating all this heavy processing, what safeguards are in place to ensure the system itself isn't making errors? Section 4. Evaluating automated controls. This is where we verify that trust.
You have to evaluate the automated controls, which are basically the internal security guards of the system. And for the exam, you need to clearly distinguish between two types. Application controls are specific. They relate directly to transactions and standing data to flag any risk of material misstatement. IT general controls, on the other hand, are the broader, big-picture policies and procedures. They support the entire IT environment to ensure that those specific application controls can function effectively in the first place.
And right within that framework, we have master file controls. Master files hold the absolute critical standing data of a company. So master file controls are stringent security measures designed to ensure the ongoing integrity of that data. As an auditor, your assessment of these specific controls is going to heavily dictate the scope of your entire audit. If the master file controls are weak, the integrity of the data is compromised and, well, you're going to have a lot more substantive testing to do.
Section 5. IT Audit Testing Methods. Let's look at how you actually test these controls in the field. So how do we know the controls are actually doing their job? There's a hierarchy of 4 testing methods you need to know. Step 1 is inquiry, just asking questions. It's super fast and efficient, but you definitely have to pair it with other methods for it to be reliable. Step 2 is observation, literally watching a user record transactions. Step 3 is inspection, where you might review a system's configuration or technical manual. And step 4 is reperformance. This is absolutely the most effective test you can do, but it is highly time-consuming.
Finally, Section 6. Mastering the audit trail.
Unlike the old days of manual ledgers, an automated software environment generates its own edit log completely automatically. This is the audit trail. It's a log that records literally every activity occurring within the system. It captures exactly when, how, and by whom an action was done, including any edits to master files and transactions. It is an unerasable digital footprint. The whole point of this? User accountability. A robust audit trail holds everyone accountable because every single action is tied to a username and a timestamp. It prevents unauthorized data alterations, and if someone does mess with the system, it helps you rapidly trace material misstatements right back to the source. It is absolutely vital for security.
So, I want to leave you with this thought to ponder. If an automated audit trail perfectly records every single action, who is responsible for auditing the trail itself to make sure it hasn't been tampered with? As you continue prepping for the CMA exam, always look for that next layer of security. In digital auditing, trust must always be verified.
Today, we're tackling a totally critical, high-yield topic for your CMA exam, controls in an automated environment and the auditor's role. You know, when we're dealing with modern businesses processing literally millions of transactions, traditional manual auditing just goes out the window. It's impossible. So we really need to understand how automated systems are controlled, and more importantly, how you, as the auditor, step in to evaluate them. Our goal today is absolute mastery of this high-volume automated audit environment, so you can walk right into that exam room feeling totally confident.
Okay, let's dive into this. Think of this agenda as your cognitive roadmap and syllabus checklist for mastering the flow of data. First, we'll look at the automated audit environment. Second, application and input controls. Third, processing and output controls. Fourth, master file controls. And finally, we'll open up the auditor's testing toolkit.
All right, let's jump right into Section 1, the automated audit environment.
Like I just mentioned, manual auditing simply doesn't work for modern IT systems. You literally can't sit there with a pencil and check a million automated sales invoices, right? Which is exactly why in an automated environment, auditing undergoes some massive changes, and our whole priority shifts to evaluating the system's controls first. This brings us to a really foundational rule you need to know for your exam. The authenticity and the reliability of information in an automated environment largely depend on the controls in place. Basically, before an auditor applies any specific audit procedures or substantive tests, they absolutely have to evaluate these controls to ensure data authenticity. Because think about it, if the controls are weak, the data is weak, and your risk of material misstatement just goes through the roof.
Moving right along to Section 2, Application and Input Controls. So now that we know why controls matter so much, let's actually begin our journey through what I like to call the data pipeline. We're going to start with the very first line of defense, application controls. Let's break down this textbook definition a bit. Application controls are those controls, and these can be manual or computerized, that relate to the transaction and standing data in a computer-based accounting system. For an auditor who's assessing financial statements, ascertaining, recording, and evaluating these specific application controls is step one for determining the risk of material misstatement. They basically govern the specific, actual tasks that the software is doing.
Okay, I highly recommend you memorize this specific sequential journey of data. It goes from input to processing to output and finally over to the master file. Seriously, visualizing this pipeline is going to help you answer almost any exam question on this topic. If you know exactly where the data is in its life cycle, you're going to know exactly which control applies to it.
Let's move to the start of the pipeline and see how this builds. Input controls are right at the entrance. They're designed to ensure that only good data gets in. Specifically, they are control activities designed to make sure that data input is authorized, complete, accurate, and timely. You know the old saying, garbage in, garbage out? Well, as an auditor, you need to apply specific input validation checks to evaluate this whole gatekeeping process. I strongly encourage you to grab a screenshot of this slide for your notes. This right here is a heavy memorization area and a huge favorite for multiple choice questions on the CMA exam. So let's run through them really quickly. Range checks ensure that the inputted information is reasonable and aligns with expectations. Compatibility checks make sure data from multiple fields is compatible. Validity checks, well, they ensure the data input is actually valid. Exception checks produce a report that highlights any unusual situations following an input. Sequence checks help with completeness by rejecting out-of-sequence documents. Control totals compare manually prepared pre-input totals to the totals actually input, just to ensure nothing got lost in the shuffle. And finally, check digit verification uses specific algorithms to mathematically ensure the data input is completely accurate. And this brilliantly illustrates one of the trickier terms on that list, compatibility checks. Quick exam tip for you. Compatibility checks ensure that data input from two or more fields match up. So, think about a real-world scenario. A sales invoice value must be mathematically compatible with the amount of sales tax charged on that exact same invoice. If a system allows a $100 invoice to have, say, a $50 standard sales tax, well, your compatibility check has definitely failed. All right, Section 3, Processing and Output Controls. So, we've successfully secured the entrance, right? But what happens when the data is actually crunched by the system? And what happens when it's finally spit back out? Processing controls exist to ensure that all data input is processed correctly and that data files are appropriately and accurately updated in a timely manner. Please pay attention to this critical exam detail. Processing controls for a specified application program absolutely must be designed and then tested prior to live running with real data. You cannot test your processing logic on live company data, because if that processing control happens to be flawed, you've just corrupted your entire live database. Then, once the data is processed, we hit output controls. These exist to ensure that data is processed and distributed only to prescribed, authorized users. Now, the strictness of output controls will definitely vary from one organization to another, mostly depending on confidentiality and the size of the organization, but they commonly use things like batch control totals and exception reports. Remember, confidentiality is the key word here. As the auditor, you have to verify that sensitive output isn't just sitting on a public printer or landing in the wrong employee's inbox. Moving right along to Section 4, Master File Controls. This brings us to the final resting place of the data pipeline, permanent storage. The whole purpose of master file controls is to ensure the ongoing integrity of the standing data contained in those master files. Standing data is basically your relatively permanent data, things like customer addresses or employee pay rates. It is vitally important that stringent security controls are exercised over all these master files. Why? Well, because evaluating the effectiveness and adequacy of these master file controls largely determines the auditor's workload and the entire scope of the audit work. If the master files aren't secure, the foundation of the entire accounting system is basically compromised.
Let's wrap things up with Section 5, the Auditor's Testing Toolkit. We've looked extensively at the automated system itself, but how does an auditor actually go about testing and verifying this pipeline? Now, what's really interesting about this slide is the constant battle we see between efficiency and effectiveness in auditing. According to your text, you apply 4 types of tests to identify control reliability. First is inquiry, which is exactly what it sounds like, asking knowledgeable individuals questions. It's the most efficient, for sure, but it absolutely must be used in combination with other methods. Second is observation, which means witnessing a user actually record a transaction. Third is inspection, where you examine configurations or technical manuals. It's a highly reliable digital check. And finally, reperformance, where the auditor independently executes the process all over again. Reperformance is easily the most effective method, but it is incredibly time-consuming and much less efficient. So, as an auditor, you really have to balance these trade-offs based on your specific risk assessment.
So the crucial point is how you practically apply these tools in an automated environment. Some really common testing scenarios include obtaining an understanding of a process by doing walkthroughs of end-to-end transactions, using a mix of inquiry, observation, and inspection. You might observe how a transaction is recorded by a user across different scenarios, or you could inspect the configuration of a specific application control. A really great example from the text is negative testing. This is where you intentionally perform a test check using bad data just to observe if the appropriate system error message pops up and the system actively rejects it.
I want to conclude our explainer today with this provocative thought. Just imagine you're performing that negative test, and this system happily accepts your intentionally flawed, totally invalid data. If your negative testing reveals a total failure in the automated input controls, how radically does that change your reliance on the entire data pipeline? Remember, if the input controls fail at the gate, everything downstream, the processing, the output, the master files, is potentially contaminated. Keep that cascading impact in your mind as you study.
Look, I know you're all deep in the trenches of your exam prep right now, so my goal today is super simple. We're going to extract exactly what you need to know directly from your syllabus and make it incredibly easy to digest. No fluff, just the core text provided for your exam so you're studying the right material as efficiently as possible. Grab your notes, get comfortable, because this explainer is literally your ultimate blueprint for mastering audit trails.
Here's our quick roadmap for today. We're hitting 5 key areas: the core concept of an audit trail, the statutory requirements, how the log actually operates, its benefits, and we'll wrap up with the auditor's duty to report.
All right, let's jump right into Section 1, the concept of audit trail. Let's build our foundation here. From an exam perspective, you absolutely must memorize this definition. An audit trail is essentially the collection of documents and records relating to transactions. It's what enables an auditor to trace those transactions directly from the raw source documents all the way to the summarized total in the accounting reports. Think of it as an orderly step-by-step digital footprint. It's undeniable proof of a transaction's history, tracking the whole shebang from initial entry to any subsequent changes.
To really visualize this, let's look at how a manual audit trail process works first. Picture a physical, sequentially numbered sales invoice. Copies of this invoice would normally be listed out in a daybook or a register. After that, they get filed away, either numerically or chronologically. Because of this superstructured system, an auditor can easily trace a specific invoice from that summarized daybook right back to the original physical file, just by referencing the invoice number or date. Pretty straightforward, right?
Now let's see how this completely transforms in an automated environment. Honestly, modern accounting software provides the absolute perfect example of an audit trail. The second a transaction is entered, the software instantly maintains a record of it. If anyone makes further edits, say tweaking a vendor's name or changing a transaction amount, the software catches it. It tracks exactly who made the change and at what exact time. And here's the kicker. Even if someone tries to delete a transaction entirely, the software tracks that deletion too. It keeps a permanent, unshakable record of everything since that very first original entry.
Moving right along to Section 2, Statutory Requirements for Companies.
Okay, let's shift from the theory to the actual law. You really need to pay close attention here because specific rule numbers and dates are highly testable material. Burn this date into your brain, April 1, 2022. According to Rule 3.1 of the Company's Accounts Rules from 2014, which, by the way, got amended in 2021, this date is the critical milestone. For any financial year starting on or after April 1, 2022, every single company using accounting software to maintain its books is legally bound by a strict new mandate.
So, what exactly does this mandate demand? Well, the law dictates that companies can only use accounting software that has a built-in feature to record an audit trail for every single transaction. It has to create an edit log of every change made in the books, alongside the exact dates of those changes, and this is huge for your exam. The software must ensure that this audit trail feature absolutely cannot be disabled. In plain English, the expectation is a permanent edit log that you literally cannot turn off ever from the moment a transaction gets recorded.
So, we know the law strictly requires it. But let's take a mental breather for a second. How exactly does an audit log actually operate under the hood within the complex IT infrastructure of a modern company?
That brings us to Section 3, how an audit log operates. Now, the operation of these logs isn't just a simple one-size-fits-all thing. It depends heavily on the specific operating systems, applications, and devices an entity is running. Think about the contrast here. Unlike manual records that literally require a human being to sit there and input the logs, which is slow and, let's face it, prone to human error, an automatic record relies on automated logs. These trails automatically record every single activity within the system. They capture all the granular details of when an activity was done, how it was executed, and by whom. It even captures the system's exact response to those activities.
Let's zoom in on the edit log feature itself. This feature allows for the tracking of edits across all masters and every single transaction. It meticulously grabs the date details and the exact username when any change is made, and it can even generate difference reports. Because it captures such rich, detailed data, it makes it incredibly easy to spot unauthorized changes that could ultimately cause material misstatements. It's a real game changer for accuracy.
All right, Section 4, Benefits of Audit Trails.
Listen up. If you get a short answer or essay question asking for the advantages of audit trails, this is your cheat sheet. You need to memorize these 4 key pillars. Number 1, user accountability. Number 2, data security. Number 3, the reconstruction of events. And number 4, the detection of system interference and errors. Let's break these down real quick so you truly get them.
First up is user accountability. In an automated environment, the system is basically always watching, recording the activities of every single user. Naturally, this promotes appropriate behavior simply because everyone knows they're going to be held accountable for their actions, right? This strict tracking prevents unauthorized alterations of data, stops internal staff from introducing viruses, and is absolutely vital for identifying outside intruders. And that accountability naturally feeds right into broader data security. It protects the organization's data from unauthorized access and fraudulent activities, whether that's coming from an employee or an external hacker. Plus, if a breach actually does happen, the audit log allows you to reconstruct the events. An excellent system lets an organization piece together exactly how cyber attackers operated. In some critical situations, it even makes retrieving the lost data possible. Finally, it detects upcoming system interference, failures, and errors, which lets the organization respond proactively instead of just reacting when things break.
Okay, homestretch. Section 5, Auditor's Duty to Report.
Let's tie all of this legal and technical stuff back to what matters for your future career. What is the auditor legally obligated to do regarding these trails? Well, just like I told you to memorize Rule 3 for the company's requirement, you must memorize Rule 11 for the auditor's requirement. Specifically, Rule 11 of the Company's Audit and Auditor's Rules from 2014 amended in 2021. This rule lays out a strict checklist an auditor has to verify, and again, this applies to financial years starting on or after that magic date, April 1, 2022.
Under Rule 11, the auditor essentially has a 4-part checklist to formally report on. 1. Did the company actually use accounting software with an edit log facility to maintain its books? 2. Did this audit trail operate continuously throughout the entire year for literally all transactions? 3. Can the auditor confidently confirm that the audit trail feature has not been tampered with? And 4. Has the audit trail been properly preserved by the company according to statutory record retention rules? As an auditor, you have to verify every single one of these points.
So, I'm going to leave you with this exam-style scenario to chew on while you study. Imagine you walk into an organization to audit them, and you discover that their software's edit log can just be casually toggled off by a manager. How would you, as the auditor, handle that tampered system under these strict 2022 rules? What exact rule violations would you be required to report? Think deeply on that as you review your notes. Keep hammering these specific syllabus details, and you are absolutely going to ace this section of your CMA exam. Thanks for joining me on this explainer, and happy studying!